About 3 weeks ago, I released a video analyzing Supermicro computer stock, and ever since that video, the stock has gone up about 106%. Currently, the stock is trading at around $37 per share, but it got as high as $118 per share. So the question becomes, can the stock bounce up again to these levels? Because if it does, this could mean a potential return of around 219%. But to understand if this is realistic, I have to take you back to the moment the stock first collapsed. This all happened for the company in August 27th, 2024, where Hindenburg Research released a report that you can see right now that talks about some of the issues that the company engaged in allegedly. And some of these issues and some of these accusations include glaring accounting red flags, evidence of undisclosed related party transactions, sanctions and export control failures, and customer issues. The report also talks about how in 2018 the company was actually delisted from the NASDAQ, and the reason why this happened is because a widespread of accounting violations. The company then settled with the SEC, and some of these violations including the improper recognition of revenue, understanding of expenses, and artificially inflating sales and profit margins. Shortly after, the company's auditor, EY, resigned from being the official auditor of the company. And the reason that they cited was due to information that has recently come to our attention, which has led us to no longer be able to rely on management's and the audit committee's representations and to be unwilling to be associated with the financial statements prepared by management. This is quite a big accusation. And if you think about it, EY will not resign unless they really had a strong reason for it. Otherwise, they would lose a client and they would lose quite a bit of revenue. But the reason why Supermicro computer stock is so interesting is because the company, first of all, is part of an amazing market. The market is expected to have a compounded annual growth rate of around 8.7% and is benefiting in large part for many different trends such as the development of AI, chips, as well as machine learning algorithms and cloud age and data center solutions that are being developed in the market right now. At the same time, if I pull the financials from Y-Sheets, which is a plugin that works on Excel and Google Sheets, and I just type the ticker and click on Get Data, I'm gonna get the financials. And what we find for the company is that it has phenomenal revenue growth. As you can see right now, we have a growth of 110% in 2024, 37% in 2023, 46% in 2022, and 7% in 2021. This is a big reason why the stock completely took off from this period all the way down to here, and why also the stock has potential for big returns. It all comes down to whether the company committed fraud or bad accounting practices. If they did commit such fraud, then the stock will only continue to tank even more than it has now. But if they didn't and the company's numbers are correct, the company is bound to take off. To tackle this issue, Supermicro announced the completion of a review by independent special committee, and what they found, amongst many different things, is that the resignation of the company's former registered public accounting firm, EY, Ernst & Young, and the conclusions that EY stated were not supported by the facts examining the review and the special committee's interim findings reported to EY on October the 2nd. Basically, what they're saying is that what EY reported is not true, and there should not be fear for investors or shareholders or customers to drop the company for these particular reasons. At the same time, they announced the appointment of BDO as their independent auditor and filing compliance as part of a plan with the NASDAQ. Even the CEO of the company had to jump in and say that he's confident that Supermicro will not be delisted and that the company will meet a new deadline by the NASDAQ to submit its delayed filings to the US Securities and Exchange Commission. And they announced that they were granted an extension to submit these filings by February 25th without delisting the company right away. This is going to be the key catalyst that decides what happens to the stock and whether or not you're going to make a great return with this particular company. In February 25th, mark that date on your calendar, because if the company releases positive financial statements that are supported by the new auditor, then the stock can do really well. But if they don't, then we have a lot to worry about. The main problem is that if the company reports some bad numbers, or if the auditor does not report a positive sentiment about the company's accounting numbers, then the stock is most likely going to get delisted, because obviously that is not compliant with the NASDAQ guidelines. And the interesting thing is that this actually happened in 2018. So as you can see, the stock here is doing fairly well. And then when this happened, boom, the stock took a dive. Here the stock was not as high in price, so the dive is not as drastic as it would be right now. But you can see that this actually happened and it had a big impact on the company. And then the company got listed again and started to have really high revenues, and then the stock price also went up. But if this happens again, the company gets delisted, then the stock price will definitely tank and it's gonna be traded. The company will now only be traded in OTC markets, most likely. So there's gonna be less liquidity around the stock and less regulations, which can mean that if they really want to cook up the books even more, they can do it. So my advice is to wait for the February 25th filing, and then as soon as you see the filing, do not wait, be very proactive. And if the stock is tanking down because some accounting issues, then perhaps that is a good opportunity to short, although you have to be careful with how that works if the company gets delisted. But more importantly, if they release positive news, then that's the time to go in and then just reap the rewards. But before you do that, you need to know what price is reasonable for the stock. So my previous stock analysis video, with the help of white sheets, I created this valuation model based on a whole bunch of different assumptions, all based on a lot of research, of course. And as you can see in the results of this model, we get these numbers where with these assumptions, which I think are pretty reasonable for this company, we get a stock price of around $37.28 per share. So this is the price to keep in mind, because even if the company releases positive news and the stock takes off, you do not want to pay that much more than this price right here. Maybe you want to pay maybe like 40, 50 is even pushing, so maybe like 45, but anything like that, then it would be too much. And then even if the stock continues to grow, perhaps it might not be growing as much as you think. If you like this video, make sure to subscribe to the channel, comment what stock analysis you would like to see next, and I'll see you in the next one.